some of the participants who are still currently joining. So maybe probably in the next 1 or 2 minutes, we'll be officially starting. So thank you so much and welcome. All right, so thank you so much and welcome back once again. So I know today is a great day actually, and I believe towards the end of this session or during the session, we have an opportunity to learn from some of our specialists in different areas of their specialization. And today, I know it's been a day which most of the participants have been really waiting for. And I know whatever conversation which we are going to basically have today is something which, if you are within the virtual assets ecosystem, it's a conversation which has already created a wave. And every now and then, I can't recall how many days I've been jumping into my social media platform, and anytime I visit the social media platforms, the key thing which is standing out is virtual assets and how regulations, compliance are basically being handled within that ecosystem. So before we basically delve in this conversation, I just want us to let us know that matters of compliance, matters of building within the virtual asset space, it's a key issue and a key trending thing. And I know with most of the people have been asking themselves, how do they basically build within the virtual assets ecosystem or operate in this space without being caught on the wrong side of regulation, or maybe probably finding yourself in the risky bit of it. And today, during these conversations, of course, we are going to demystify the ambiguous words of regulations, compliance, and risk, so that you can be able to be in a position where you can actually be able to understand. And on this call, definitely for those people whom I'm meeting for the first time, my name is Sale Wycliffe, and I'm the managing partner for A&D Forensics. And for the benefit of those who have not had an opportunity to interact with A&D Forensics before, we are a risk and compliance consulting firm. And of course, when it comes to matters of virtual assets, we support a lot of financial institutions when it comes to risk and compliance within the virtual assets ecosystem. We also support law enforcement when it comes to tracing illicit flows that happens within the virtual assets, or if you like it, or if you can be able to put it, we call them crypto-linked crimes. So ideally, that's how we normally operate, and the kind of support which we normally offer within the virtual assets ecosystem. So today we are also fortunate to be joined by an elite team. Of course, we have got different speakers who will be sharing with us their perspective as far as the virtual asset is concerned. And allow me to start with Bill Okello, who is also one of the speakers whom we currently have. And by virtue of introduction, I'll be mentioning or sharing their bio, and I believe during the conversation they'll also get to share with us what they do in the space, in the virtual asset space, based on whatever has been captured in their bio. So Bill is an advocate of High Court of Kenya, and is the legal counsel of Stickhouse Financial, who are building transparent, accessible, institution-grade DeFi tools to power the next generation of capital markets on public blockchain. Bill Okello is the director at Virtual Assets Chamber of Commerce, and maybe probably you'll also get an opportunity to share with us what happens at the commerce or at the chambers, all right? Whose role is to support and advance the chamber's mission of promoting favorable policies and regulations for virtual assets sector. The next speaker, whom also we are going to have an opportunity to interact with, His name is Senator Inhenyen. It's a very tongue-twisting name, and maybe probably will also have an opportunity to share with us where did he actually acquire that beautiful name from. In my first time, it's actually the first time I'm coming to hear about such a name across the African continent. Very unique in its nature, of course. So Senator is the leading partner of Infusion Lawyers, a virtual intellectual property, IP and information technology law firm for the knowledge economy and the digital age. He is the head of the innovation and emerging technology, and Senator also provides legal, compliance, and policy advisory to both global and local blockchain and crypto companies and businesses clients. He helps clients navigate the challenging and dynamic blockchain and crypto businesses and regulatory environment. Senator is also the founding trustee of the Virtual Asset Service Provider, which is a Pan-African network for virtual assets innovators, policymakers, and other players. And I believe also during the call, you'll also get an opportunity to share with us just in brief what happens at the VASPA corridors. So with us as well, today, I'm not going to be the moderator. Of course, we have got a very special lady, wonderful indeed, who will be taking us through the moderation phase, who is also, for those people who had an opportunity to interact with the flyer, you could see very strong, abled men. And we normally say behind every successful man, there must be a lady always. So on us also, we have Rhoda Muthoni, who will be taking us through the moderation session. And with apologies, I know we had our third speaker called Apollo, but currently there's an emergency issue which is currently handling. If he manages to join us as we proceed, it will be well and good. If not, then definitely the session will be covered up. So without much ado, allow me once again to thank you all for taking and creating time to join us into this wonderful conversation. This will not be a lecture. This is just conversing and getting to know what happens within the space. So Rhoda, if you can be able to hear me from that end, can you hear me?
Yeah, I can hear you, sir. Hi, how are you?
Thank you so much and welcome.
Thank you very much. My name is Rhoda, and I will be your moderator for today. But before we dive into this discussion, just like Seve had mentioned, I'm going to allow Bill and Senator to share more about, like Bill, what happens at VSCC, and so he's Senator, what is the Infusion Lawyers? We need to hear just like a minute, and then we can dive into today's discussion. Welcome.
Thank you, Rhoda. I believe that you can all hear me.
Yes.
So thank you, Sarah, for the introduction. I appreciate it. As I've been ably introduced, I am an advocate of the High Court of Kenya, practicing in the virtual asset space. So what do we do at the Virtual Assets Chamber of Commerce, so VSCC? So VSCC is building a trust infrastructure for borderless markets in Africa. What does this mean? It means that we bring together regulators, policymakers, financial institutions, virtual asset service providers, and innovators to shape sound rules, to raise market standards, and to help Africa participate confidently in the next generation of finance, which, as we all know, is virtual assets. This is where the world is going. Yeah, thank you.
All right, thank you very much, Bill. And over to you, Senator.
Thank you very much, Rhoda. My name is Senator Inhenyen. And yes, Sarah was wondering how I came about the name Senator. For those wondering on the platform, Senator is not a political title of mine. It's my first name, just like Rhoda's first name. Right. I would say that I was born on the day of a senatorial election, and my dad called me Senator on that day. So that's the idea. I am lead partner at Infusion Lawyers, which is a law firm that services both local and global players, especially in the tech space. I lead the emerging technologies and innovation practice, where I get to do a lot of work around advising startups around compliance, legal, policy issues, and helping them support regulatory compliance, really. At VASPA, which I founded in 2024, the Virtual Asset Service Providers Association, called VASPA, is an association of virtual asset service providers. What we try to do is ensure that we are able to create a safe balance when it comes to regulation policy around the emerging sector called virtual assets. We currently do some work trying to bridge the gaps in the space as far as trust and confidence is concerned. And we work with both innovators and regulators across Africa. Bureau Kelo's virtual assets chambers, the assets chambers, is one of the key players in that space. And we have had reasons to, talk about what we can do for Africa together. I'm happy to meet Bill here on the platform. Thank you.
All right. Okay. Now, having known our speakers, please, you can as well share. I don't know, you're going to share your LinkedIn profile link so that we can connect with each other, not only to speakers, but all the participants here. Now, diving into this discussion, to Bill and Senator, would you please give us perspective on how the regulatory environment currently looks across key Africa markets? So we are looking at South Africa, we are looking at Nigeria, Kenya, we are looking at Ghana, and many other African countries, how the regulation is currently is. And the question number 2 is, should be there a startup company want to choose a place to establish itself, which country appear more structured or welcoming, and which one still feels kind of uncertain? So over to you, speakers.
I think I'll start. I'll take a few countries, and Senator is very well able to take the rest. So let's start with South Africa. So this is the most probably developed example in virtual asset adoption. So I think Africa right now is no longer in the wait and see phase in virtual assets. So we are seeing the market move into a much more formal regulatory phase, and countries are not all moving at the same speed, but the point is we are all moving. So South Africa is probably the most developed example. The Financial Sector Conduct Authority declared crypto assets to be financial products under the Financial Advisory and Intermediary Services Act, and they began licensing crypto back in June 2023. So it has a live licensing regime. However, I think we've been seeing in the internet that there have been some squirm in South Africa on virtual assets. So there's a new issue. There's a draft capital flow management regulations, which just came out, I think, sometime this month, which intends on bringing crypto assets directly into South Africa's cross-border capital controls framework. Now, this has attracted a lot of market feedback. If you're active in the virtual asset space, you've seen that a lot of people are, there's a lot of pushback because of the fact that they're requiring access to information, password, pins, codes. So this would even be access to your private keys. So you're liable, or rather it's punishable by law if the regulator asks for your private keys and you do not provide it. While we know that in crypto, it's the whole thing about crypto and how it started, or rather virtual assets, is on decentralization. Bitcoiners usually say, not your keys, not your coins, and this has been a key factor in the virtual asset space, especially on self-custody. So that's what we are seeing in South Africa. However, apart from the new regulations, they've been very advanced. Once they regulated the space, transactions actually, there were more transactions. The volumes went higher because more businesses could adopt virtual assets. Banks could adopt virtual assets. We've seen traditional financial institutions get into this sector in South Africa. I mean, an example is ABSA is doing custody of virtual assets with in collaboration with Ripple Custody. So this is what happens when a space is regulated, and now even the legacy financial institutions, as I like to call them, enter this space. Enough about South Africa. Let's come closer. Let's come home now to Kenya. So we know Kenya has moved significantly. We now have the Virtual Asset Service Providers Act, which was passed last year, 2025, and it came into force, I believe, on 4th November. It was signed in October, came into force on 4th November, 2025. And recently, what we've been seeing in Kenya is the draft VASP regulations. Now, an act provides just the framework. The regulations provide how this is done. So the act provides the what, and the regulations provide the how. So of course, with Kenya, we've also seen a lot of pushback with the regulations, given that there are high capital requirements. An example, but let's remember that these are draft regulations. An example is to be a stablecoin issuer, you need to have at least 500 million Kenya shillings in capital. I'm seeing Senator shaking his head. To be a cryptocurrency exchange, you need to have 200 million Kenya shillings. Now, these numbers are quite high, and there's also a lot of compliance requirements. But I'm not here only to complain about the regulations. I mean, we commend the regulators for having the act. It is not perfect, but it is a very good act, and we think that if we just work on these regulations, it will be very beneficial. And another thing to mention is that in Kenya, there's a two-regulator approach. So virtual assets are regulated by the Central Bank of Kenya and the Capital Markets Authority, depending on exactly what you're doing, the activity that you're doing. So public participation on the regulations closed on the 10th of April of 2026. And Kenya is moving into formal licensing. In fact, the other day we saw the central bank advertising for virtual asset service provider positions, where now they're just preparing themselves for licensing. And the final country I'll cover is Rwanda. So Rwanda is also a very important jurisdiction. We saw initially last year, the Rwanda released a draft virtual asset service providers bill. And right now cabinet approved the draft law to regulate virtual assets. The direction there is clear. Rwanda wants to allow responsible innovation, but with a framework that protects the financial systems and aligns with Financial Action Task Force standards, and to make clear that virtual assets are no longer are not legal tender, but Rwanda is moving in the right direction. And we've also seen in Rwanda, they're doing a test on their central bank digital currency. The Central Bank of Rwanda is doing a pilot on possibly having a central bank digital currency. So this is quite good. I have not covered the biggest country or the biggest market in Africa, because I know Senator will ably cover that and other countries. Thank you.
Thank you. Thank you so much, Bill. Senator, you have something to add?
Yes, thank you very much. Bill has graciously saved me from any embarrassments. Assuming I were to know nothing about those countries, he just finally covered. They say charity begins at home, so I'll start from Nigeria, and I think Bill has suggested I should start from there as well. In Nigeria, as with the African continent, there has been a shift away from the gray zone to a green light generally. Before now, Nigeria used to have frictions and restrictions. As a matter of fact, there was a ban in 2021, which lasted for as long as 3 years. But that has changed now, because there is now what we call the Investments and Securities Act 2025, which recognizes virtual assets or digital assets as assets in the capital markets, specifically security, within the purview of the Securities and Exchange Commission. By virtue of that, we can say safely that there is some level of formalization of the adoption of crypto assets or virtual assets in Nigeria. Of course, this is also complemented by the virtual assets regulatory guidelines by the Central Bank of Nigeria, which was introduced formally in January 2024, just to also ensure that the Central Bank of Nigeria is able to work closely with the Securities and Exchange Commission as far as the adoption of virtual assets is concerned in the financial services industry in the country. Before now, we already had the Money Laundering Act 2022, which recognized virtual assets and also virtual asset service providers as financial institutions for the purpose of ensuring that there will be compliance with the country's anti-money laundering laws, so that we can check against the illicit use of crypto assets for money laundering, tax evasion, terrorism financing, and the rest of that. So as for Nigeria, yes, you could safely say that Nigeria has opened its doors, and the transition towards full licensing is on its way as we speak. We expect that anytime from now, the licenses should start rolling in, as long as there are no national security risks around it. Just close to Nigeria, of course, is Ghana. And Ghana has made significant progress, especially in the last 1 year. In December of last year, the parliament in Ghana passed into law the virtual service providers bill, and that law is now in place. What Ghana is trying to do now is to formalize the regulatory framework by virtue of the law that was passed last year, and see how licensing of virtual asset service providers could start in earnest. I'm aware that the Bank of Ghana already introduced a pilot or a sandbox to enable innovators get into the sandbox and be able to innovate safely within that environment. We believe that there will be data that will be shared, of course, by the innovators, which will then help the regulators in Ghana be able to come up with the right frameworks, so that hopefully we don't have the issues that we usually have around or across African markets, whereby after working so hard with the regulatory frameworks, you will then find that the capital requirements are too huge or too steep for startups, especially to take up, as we now have in places like Kenya, as Bill has also mentioned. I just want to also add Mauritius in Africa. And I'm adding Mauritius because long before the Kenyans and the Nigerians and the Ghanaians and others started getting this right, we had Mauritius already have a virtual assets law, which was driven back then by the capital, by the authority in charge of bringing in investments or capital into Mauritius. And since then, Mauritius has been very attractive to not just African innovators, but also non-African innovators who believe that Mauritius provides the most friendly environments. But of course, as you'll get to know in the course of this program, the most friendly or business friendly doesn't also automatically mean the safest necessarily. You know, there's always this balance between innovation and regulation, which continues to throw up various variables that I'm sure the CEOs and founders in the house and the compliance officers in the house continue to grapple with. So that's the big picture. And it's good to actually see that Africa is shifting towards green lighting in innovation in this area rather than banning and restrictions. Thank you.
Well, thank you very much, Bill and Senator. But one thing that I've not heard from you, both of you have not shared about the startup, the question for startup that I have. Yeah, which countries seem to be more structured and welcoming and which one feel uncertain? Please let me be mindful of time. Each can take like 1 minute and a half. Yes.
So in my perspective, as a startup, it majorly depends with what you're doing and who's your target market. So of course, some things in these regulations are similar, some of them are different. So what exactly are you doing? Are you doing cross-border transactions? Are you doing tokenization, real-world asset tokenization? Do you want to launch stablecoin, for example? So if you, first of all, figure out what you want to do, then look at the jurisdictions. What do the laws say? What are the capital requirements? What are the compliance requirements? Of course, it's not a one-size-fits-all. For every startup, there'll be a different jurisdiction that perfectly fits their needs. So as much as I would like to say Kenya to bring virtual asset service providers to Kenya, I think just look across the African countries and just see which one best fits your needs. It might be Kenya, it might be Rwanda, it might be South Africa, it might be Nigeria. Nigeria has the largest market and largest adoption of virtual assets across Africa. Everyone is thinking of Nigeria, it might be Ghana. So it depends on your needs. And that would be my answer.
Thank you. We are dealing with lawyers here. Senator, you have something to add?
Yes, thank you very much. And I think Bill Okello has done justice to that question. It's not a one-size-fits-all approach at all. If you approach it that way, you will make mistakes, certainly. It really starts with what you are building, what products or services you're offering, and you'll find that relatively certain jurisdictions might provide more advantages to you depending on what you have built or building. For example, as noisy as a place like Nigeria could be, when you hear about Binance and all the fights going on in Nigeria, you might be surprised to know that there are real world assets companies who are already building a lot of stuff in Nigeria, and they are just fantastically fine. But by the time you move into the P2P space in Nigeria, you are going to face what you're looking for. So really, it really starts with that. I think for startups or founders in the house who might have one or two unanswered questions in that area, they could reach out so that we could look at exactly what the risk their particular or specific products offer. Thank you.
Thank you very much. Now getting to understand how the regulation environment looks like, they have broken it down for us when it comes to South Africa, Kenya, Rwanda, Nigeria, Ghana, and Mauritius. And also given us some of the things to consider if you are a startup and looking for a market in Africa. Now to you, Bill. If we look across Africa, we are seeing different countries moving at different speed when it comes to crypto regulation. Please give us perspective. What is really driving these differences, and what should business pay close attention to right now as the framework takes shape? If we can, less than 5 minutes, I'll appreciate. Okay.
I'll try to keep it brief. No liars, you can speak the whole day. So I think from my perspective, the first major driver, of course, is adoption. So regulators are moving because people and businesses are already using virtual assets. If no one was using it, then there wouldn't be need to regulate it. So I think virtual assets is no longer a theoretical conversation like we used to have back in 2013, 2014, when you're trying to figure out what Bitcoin is and all that. So across the continent, people are using crypto and stablecoins, or rather using virtual assets and stablecoins for remittances, for savings, for cross-border payments, for trading, for settlement, and access to dollar liquidity. I mean, we all know that. So once adoption reaches a certain level, of course, regulators will have to respond. We've seen that there've been a lot of when people are adopting a new technology, of course, there's also bad players. So there's been a lot of scams. People have lost a lot of money because other people want to take advantage of those who don't understand this space. So when you regulate it, you actually control this. People know that a regulated company is a trusted company. And if anything were to happen, the regulator has my back. That is, so one, I'd say adoption. The second major driver is the Financial Action Task Force pressure. So especially recommendation 15 and 16 and recommendation 15 and recommendation 16 on the travel rule under travel rule under recommendation 16. So the Financial Action Task Force has made it clear that countries need to identify, license, or register VASPs, supervise them for ML and CFT risk, and ensure that virtual asset transfers are not being used to move illicit funds. So many African countries are coming up with regulations. We've seen around the same time, Rwanda, Ghana, Kenya, Nigeria are doing this around the same time. So of course, these are we subscribe to the Financial Action Task Force, and these are some of the recommendations. Another driver, of course, being also ancillary to the Financial Action Task Force, is grey listing. So most countries have been grey listed by the Financial Action Task Force. An example is South Africa was grey listed. South Africa regulated this sector and of course also put more robust AML rules and anti-money laundering and terrorism financing rules, and they got out of the grey list. Nigeria, the same. They started regulating this space, put more stringent rules, and they exited the grey list. Now, Kenya currently is in the grey list. We have not yet exited, but you see the same pattern. We are regulating the space, we are putting up these rules. So in accordance with the Financial Action Task Force recommendation and their expectations as well, just to get out of the grey list. And so it's driven by, as I've said, these factors. 1, adoption. 2, consumer protection. And the elephant in the room, the Financial Action Task Force. Thank you.
Thank you very much, Bill. So we've had the key drivers is the adoption, Part F recommendations, and consumer protection. Now to you, Senator. From your experience working with startups and institutions, are businesses generally keeping up with these regulatory changes? So when we look at what is happening in Kenya, what is happening in South Africa and Nigeria, or are they reacting to what is happening? And what does that say about how compliance is currently viewed?
That's a very important question. My experience so consulting with both institutions and startups, the difference is very clear when it comes to compliance and the approach to compliance. In that, for startups, most times they find startups busy building the innovation, right? They just want to break something. Startups want to move fast. And most startups, you find that they want to move into the markets, validate their product or services, get in capital. So as soon as you bring up the conversation around compliance, it is seen mainly as some kind of a blocker or hurdle or obstacle. So you find that there are many startups out there who don't build compliance into designing their innovations, right? And when you have an approach like that, what you find is that you will be reacting rather than being proactive. And in compliance, when you're reactive, you will run the higher risk of getting into trouble. But when you are proactive, you would have been able to significantly minimize the potential risk that would have been associated with launching or running that product or service. So for institutional players who are more established, more experienced, and have more talents, who are experienced across times the traditional financial system, they already understand the game of compliance, and they have enough resources to invest in compliance infrastructure, which, by the way, is not cheap at all most times, right? So the approach has been, for most institutional players in the States, they are a little more compared to their startup counterparts who are a bit more reactive than proactive. But based on the culture that we're trying to imbibe with in the startup ecosystem generally, what we now find is that many startups are coming up who are now building compliance infrastructure into what they are building. And good enough, there are places like A&E 6 who are also driving the idea of compliance and having compliance and training done for people, whether you are compliance officers or operators and chief operations officer. That is very good. With that kind of approach, capacity building will eventually and gradually help us build compliance into the design frameworks of innovators. I hope that my internet hasn't done me.
Yeah. You are kind of breaking through. Probably we can check it. But as we proceed to you, Sewe, Sewe is our crypto investigator. From what we see, I would like now that you're in the on the ground, please help us understand how many businesses only start taking regulation seriously when something goes wrong, whether it is banking issue or regulatory inquiries or suspicious activity, or they have been hit probably where they have been subpoenaed by law enforcement, probably they have processed stolen funds. What do you think this pattern keeps repeating, and what does it reveal about how startup approach early on?
Oh, thank you so much, Rhoda. Can you be able to hear me loud and clear? I've decided to switch on my video just in case my internet misbehaves. Yeah, thank you so much for that question, and allow me also to thank the earlier speakers who have really painted nicely on how the regulatory landscape looks like across the African continent, touching on most jurisdictions, and they've really painted an excellent picture. And well done, Senator Nabil. I know for the interest of time is really running very fast, so I'll try as much as I can to be brief. Just as you've mentioned, in my work-related activities, we handle a lot of these cases, and I was just doing like a deep screening for the cases which we have received, especially when startups reach out. Most of them are usually coming when it's an issue which they're reacting to. So if you look at that, what does it mean? It basically means that most startups, what we are currently seeing, they have really not like prioritized matters of compliance or embed it into their day-to-day operations. And today, actually, we were discussing with one of my colleagues, and we said if we had labeled this webinar and said 3 steps to scale your business or 3 steps to acquire customers globally, we could have probably have like 100 or over 1,000 participants. but because regulations and compliance is being talked in this year, that's why you can be able to see none wants to hear that. They only want to see how do we acquire 100 and multiply our business tenfold. But you see now you cannot be able to build such a business if you don't think about compliance at the end of the day. And just as our speakers have already mentioned, things are already shifting on ground. We are seeing most countries' regulators are currently developing frameworks around. And if you look at a startup, for example, startup in the virtual asset service provider, in the long run, you are also going to partner with mature financial institutions, mature banks, for example. And these institutions, they expect you to have a certain level of readiness. You really need to have proper policies, proper compliance frameworks in place. So you ideally, from the ground or from the field, what we've really noticed, the push towards compliance is not usually from internal controls, especially with the cases that you have handled in-house. The push usually comes from external pressure. And this external pressure could be maybe probably a regulator asking for clarification about a certain issue in your operation. The push could maybe probably come from a suspicious activity which has been flagged, and you mentioned it. Like I think right now, I think we have like around a couple of a few startups in the virtual asset service space who reached out when there is an external pressure. There is a suspicious transaction which got flagged out in their systems. Some of their accounts went and got frozen because they've been facilitating illicit flows. So those have been more or less like the wake-up call. And ideally, the wake-up call should be more or less coming internally on how you want your internal systems basically to operate. So if you compare what is currently happening within the startup world and the mature markets, of course, we are seeing expectations which are shifting across the globe. And in mature markets, compliance is no longer something that you can be able to add later in your operations or your processes. In mature markets, we normally see compliance becoming part and parcel of your business model. And I think with startups, that is something that they really need also to adopt that mindset in order for them also to catch up with the regulations, so that it doesn't appear as if they will be more or less operating from a reactive standpoint. When a risky transaction has been questioned, that's when now you want to question how your internal processes work. So many startups, ideally, maybe probably, they really need to have that mindset shift. Instead of treating compliance as an extra cost or more or less like a checkpoint, they will really rather start having this as something that is mandatory into their business, which will ultimately protect their business growth, and it will ultimately, of course, increase their credibility in the market. And as time goes by, the business also will be able to bloom. So I think if we were to discuss steps on how you can be able to multiply your earnings as a startup to 1,000 folds, then be rest assured compliance is also a key element that needs to be discussed around the table. Thank you so much, Rhoda.
Thank you very much, Sewe. Now, moving from understanding the regulations and the part of compliance as well, I would like also to understand some bit of how we are who we are reporting to. And now to you, Bill. Getting to understand in many market business and navigating multiple regulators. For instance, when you look at Kenya, just like you mentioned, their history cake model where we're supposed to report to virtual asset is supposed to report to CMA and CBK. We're also looking at Ghana, like Senator Hen mentioned, about sandboxing approach where the innovators, they're being given a chance. We are looking at Nigeria considering virtual asset as security. So help us understand from a practical standpoint, where do you see the biggest confusion or friction for startups trying to stay compliant?
So I think virtual assets have been asking, especially in countries such as Kenya, who is my regulator? Given that now there's more than one regulator. When I think the better question that they should be asking is, what activity am I carrying out as a virtual asset service provider? So a virtual asset service provider can touch several areas at once. So it can be a payment business, a securities business, a custody business, an ML reporting entity, and it can be in a lot of fields all at the same time, which I also get is quite confusing. So an example for Kenya is that the regulators are the Central Bank of Kenya and the Capital Markets Authority. So if your activity looks like payments, wallets, stablecoin issuance, or money movement, CBK will be most likely your regulator. If it looks like an exchange, a brokerage, an investment product, token issuance or tokenization of securities activity, CMA becomes your regulator and is very relevant. So Ghana has also adopted a similar multi-regulator approach with the central bank, with the Bank of Ghana and the Securities and Exchange Commission being centrally involved. One thing I like about Ghana is that Ghana also provides for sandbox licensing, which allows for a controlled testing before business move into full authorization, because we've seen that in this industry, there are a lot of innovative products. People are not done building new products, and having a sandbox is quite a good step. So if you don't know exactly where you lie, you can go into the sandbox and the regulator, you can work with the regulator to see how you'll be best regulated. So the real friction comes from the cross-border nature of these assets. This is what I believe. This is one of the assets that is quite is the same in all jurisdictions, or rather is very similar in most jurisdictions. And I can have stable coins now, send it to someone in Nigeria, who will send it to someone in Ghana, who will send it to somebody else in Rwanda, and all this can happen within 5 minutes. So we've not seen a product that is this cross-border before. So startup may be incorporated in Kenya. It might have users in Ghana. It can use liquidity in Nigeria. It can custody assets through an offshore provider, and it can settle transactions in stablecoins, as I've just said, across multiple countries. But the licensing and reporting jurisdictions are for where it is registered. And also the question is, does it have to be registered in all these other countries that I've mentioned? So this creates a bit of friction, because countries may treat the products differently. So one country may say that this is a payment activity. Another may say that this is a security activity. While another one will just focus mainly on the AML aspect of it. And another one will be more concerned with foreign exchange and capital controls. So where is this money coming from? Is it affecting our monetary policy? An example we've seen is with countries like Ethiopia and, of course, Nigeria with their P2P market. So this is a lot for a startup to deal with. It means that compliance now becomes a burden and becomes fragmented very quickly across all these different jurisdictions, given that you're not just dealing with that one country where you're registered or where you're licensed. This is something cross-border. So in my view, I believe that this is why a similar treatment across countries is very important. So it does not mean that every African country needs to have the same exact law tomorrow, but we do need an alignment on the core standards. So like KYC, KYB, transaction monitoring, travel rule compliance, sanction screening, custody, segregation of client assets, suspicious transaction reporting. So we do need something, and especially also information sharing between regulators. What are we doing? What do we need to do different? So the reason this matters is these systems need to be interoperable. So virtual assets, of course, as we know them, they are just cross-border by design. So if each country just builds their own completely different system, businesses will struggle to scale responsibly. Regulators will struggle to cooperate. Consumers will be pushed into unregulated channels. As you know, it is very easy to even just go decentralized. If you are in an exchange, you just move to a decentralized exchange. If you are saving If you're saving your money in let's say crypto exchange, investing in yield in stable coins, you just go to a DeFi yield. So it's also very easy to just go to either fully decentralized channels or unregulated channels, which is even more dangerous. So my thinking is just that if countries align around common compliance principles, if you can have common compliance principles across majority of countries, it becomes easier for responsible startups to operate, easier for banks to engage, easier for regulators to supervise risk. So in conclusion, I see you're really looking at me. My view is that the biggest friction is not only the presence of multiple regulators, it is the absence of a consistent treatment across borders for assets that naturally move across these borders. So let's just have similar compliance requirements. If I am compliant in Kenya, I don't have to think about being compliant in Nigeria. It is automatic. They're asking for the same things. I'm also compliant in Rwanda, I'm compliant in Ghana, I'm compliant in South Africa, because the regulators are asking for the same things. The regulators communicate, makes travel rule even easier. When someone is using my platform to send money from Rwanda to Nigeria, given that there's collaboration, and let's say I'm based in Nigeria, I already know where the money is coming from in Rwanda because these systems are interoperable. See how it even makes it easier for businesses. Everyone's work is easy. And honestly, this is the future we are building for, and that is why we are very closely collaborating with Senate as well, and also other partners across different jurisdictions to make this a reality.
All right, thank you, Bill. What I've understood is we shouldn't be worried so much about regulator. Ask yourself what activity that engage. Anyway, and now that we've understand about the regulators, and let's say now you have the license. Here now there's a compliance aspect that is expected of you. Now to you, Senator, we often see businesses invest in onboarding checks. So when you talk about onboarding checks, we're looking at KYC, KYB, and KYT, but it still runs into issue later. In your view, where do compliance efforts usually fall short? Is it in monitoring internal processes? And how business respond when something doesn't look like? So please help us understand what are these onboarding check first, and then take us through to understand how the compliance now works.
All right, thank you very much, Rhoda. You'll permit me to speak without having to switch on video, just to be sure that you can hear me clearly.
And we have less than 5 minutes, Senator.
All right, fantastic. So when it comes to KYC, KYB, and KYT, KYC, know your customer, KYB, know your business, KYT, know your transactions. When it comes to this, I have to say that what you find to be reality is very different from what you must have mapped out when you are, framing your policies. It's usually a different ball game. How do I say that? It's one thing to keep your gates closed. It's another thing to ensure that should anything you do not want get through that gates, you have a fortress in there, ensuring that there is still security, safety, and compliance happening. Now, at the time when you have various regulators across various countries passing laws and regulations around licensing, cybersecurity requirements, money laundering checks, and all that. Of course, what that means is that startups now more than ever before have a higher burden of ensuring that they have the right policy as well as technological infrastructure in place to check against things around illicit transactions on their platforms, namely fraud, scams, terrorism financing, tax evasion, money laundering, which is a very big one in crypto. So from my work so far, what I have noticed is that there is at least three basic issues. There are three basic issues. One is on the monitoring part. I see a gap in that space. So I find that most startups or businesses get to treat onboarding of customers as a one-time event. So it's more like a static snapshot. Once you just have the users, whether entity or individual, once you have captured the users' data, right, you then go to sleep, believing that you've done what you need to do. Yes, you have, but are you monitoring, right? So I think that monitoring needs to be more dynamic and not static. So if you onboard Mr. Black this morning and Mr. Black gets to be clean and not high risk, you might be surprised that in the next 2 weeks, Mr. Black could actually turn something else, become a very high risk user. It is why I think that KYT, KYC, and KYB frameworks and infrastructure need to be more dynamic in terms of monitoring, right? Another area is the internal processes, right? I find that there are what I call integration gaps. How do I mean? So there's this recurring issue where a KYT tool, for example, and the legal compliance section of that startup are not even speaking the same language. So the legal officer or compliance officer understands the jargon around compliance and all that. And then there's a tool that the startup or business has integrated. But both the legal compliance officer and the tool that has been integrated are not really in sync. So there is a gap there sometimes in the internal process. This is where I think we should have better training as well as better exposure when it comes to the kind of KYT tools or KYC tools we want to deploy. When the CEO or COO determines that this is the tool we are getting, I think they should have a chat with the compliance department first or the compliance officer first, so that by the time you invest so much money into deploying or integrating that KYT tool, you don't find that there is no synchronization between the tool that you have invested so much in and the talents in the team that take care of compliance and the rest of that, right? So the result of having a better internal process is that when the SEC in Ghana, in Nigeria, South Africa, wherever, or any of the FIUs are the financial intelligence units, whenever they conduct an audit, really they won't just be looking at the tools you bought, whether you work with A&D forensics tools or you work with Chainalysis tools or otherwise. They will also be very concerned about your audit trail. How have you handled alerts whenever the tools generates red flags that you should be following up with? And then lastly, you mentioned how do they really react when things don't look right? And I think this is the biggest shock of all. The way that startups or businesses react when they find that something has gone wrong, sometimes you could make for a very fine Kenyan movie or Nollywood, if you ask me. The reaction is usually not very great. There's this overreaction, first of all, or I would say overcorrection. So once you see that something has been flagged, the first thing that comes to mind is freeze the accounts of both the user, freeze the accounts of both the user. So before you know it, you have a number of dissatisfied users who are creating Twitter hashtags and saying you stole their money or you are not clean, you're not to be trusted because of the way you are frozen their accounts and offboarded some of them. So I think that kind of reaction is what I call overcorrection, and it shouldn't be the best practice. If we want to build digital trust, we can't also be killing user trust or user growth. There's also the opposite of overcorrection I've seen, which is undercorrection. And sometimes I don't know which one is more risky. Undercorrection is when you are the compliance officer, you get to file your reports, such as the suspicious activity reports, your SAR reports to the relevant agency. But guess what? You go to sleep. You forget about the reports you've submitted, because for you, it's just a monotonous activity. It's just checking the box. It's not really about the process for you. So I think that's another thing we need to watch out for. Undercorrection, filing and forgetting. It's not the way to go. You cannot allow suspicious activities continue on your platform just because the relevant law enforcement agency hasn't come knocking on your door. And from my experience, I find that no matter how long it takes, and I don't know, I think that perhaps those in the house who also have had the same experience, no matter how long it takes to wait and wait, what usually happens is that whether it happened in 2019 or in 2020, one day the regulators will come knocking and ask you about a certain transaction that happened 6 years ago, 9 years ago, and you'll be shocked. So the criminal law, of course, has a very long arm. You know, it doesn't look at what lawyers call statute barred, meaning after about 6 years, they don't look at it. No, anyone can come up in the next 100 years, 3026, and say that Rhoda carried out this transaction on Bill Okello's platform, and that's why Senator has come for you. You don't be surprised I'll still be alive in 100 years, you know, bringing out the bad guys. So that's the thing. So to round that off, I think the shortfall in compliance is most often compliance efforts fail because response is more reactive than proactive or principled. What we need is a robust framework that should be predefined so that you can allow businesses to move with better precision rather than just reacting as if you're being traumatized by your users, right? And when I learned at A&D Forensics, when I think 2 years ago, I went through that program, some of the best practices that I learned at A&D Forensics training was this idea of culture proactiveness. You know, when you're in a compliance game, you can't afford to be reactive. Your CEOs might want to be reactive because they just want to bring in user growth. But you, when you're a compliance officer, you have to, you are the CEO to your CEO. That's just the reality. If you are not a CEO to your CEO is going to get you into trouble. So that's what I think the culture should be: more proactiveness rather than being reactionary. Thank you.
All right. Thank you so much, Senator. Now that Bill has taken us through various regulators and what we're supposed to consider, like you said, in Kenya, we are looking at consider what activity you're involved. Plus also he has told us the most issue or the differences that we are facing across the jurisdiction in Africa. It's because of lack of common compliance principle. Now, consider yourself as a startup who has already gotten a license. Senator has taken us through what is expected of you or what you're supposed to do as a compliance person. When you're looking at the onboarding text, you're supposed to be more dynamic than static. Saying that we embrace the culture of proactiveness. Now, coming to a point of you having now these issues on the ground, you have been hit probably, your exchange has been hit probably, Now to you, Sewe, from an investigative standpoint, one thing that stands out is how quickly risk can escalate. Funds move fast and issues spread across multiple wallets or jurisdiction. Without getting technical, what are some of early warning signs or behavior that business should never ignore?
Oh, thank you so much, Rhoda. And thank you also, Senator. I know Senator has given some heavy points and very strong nuggets, especially guiding those within the virtual assets ecosystem, more so the startups. And you've mentioned about early warning signs, and apparently it's usually human nature to ignore early warning signs. I think it's human nature. The only early warning sign which human beings usually tend not to ignore is when you really know for sure you have taken bad food, and you know in the next couple of hours your stomach will start crumbling, and if you don't pay attention to that warning sign, you know what comes next. I think that's the only warning sign that human beings tend to take a little bit more seriously. But when it comes to this other side of life, of course, we've been seeing, just as Senator mentioned, most startups are more or less like reacting instead of becoming reactive. And I'm glad when he was trying to iterate some of the key points, he was also pointing out to some of the warning signs around these conversation, and maybe probably to touch on a few so that at least we save on time. Mostly, and this I will definitely share with the cases which we have tried to support in-house, and most of them that are usually of the same nature really. You look at a business, they come, they report X happened, and when you try to triangulate or maybe probably get to know what were they, why did they arrive at this particular point where they're now basically reacting, and mostly you realize that this particular startup, they didn't even pay attention to the unusual transaction behavior. So you check on the how funds were basically being moved on chain, and you see that these businesses, they really don't even pay attention, even when funds get split across multiple wallets, interacting with some of the addresses, which maybe probably they even don't know these addresses, what's their origin or source of funds. And you see in crypto, there is that aspect of speed. So if you don't maybe probably pay attention to these patterns, then you might, at the end of the day, maybe probably land into a problem. And again, another warning sign is usually around inconsistency of the user behavior. You onboard a client, maybe probably from their risk profile. Initially, they looked at if they are low risk during onboarding, but at later stages, you start noticing the kind of activities that this particular client is doing is maybe probably is not in line with the profile which maybe probably you used whenever you're bringing them on board. So this shift in user profile or user behavior whenever they're interacting your systems, you really also need to pay attention to that. I know with our businesses, we are keen into maybe probably want more commissions, and the more a client do a lot of transactions within your platform, the more it's profitable for you, maybe probably in the long run. To an extent, you may be tempted to turn a blind eye, but not realizing that if you're not careful in terms of monitoring the user behavior as per the original profile, then it might maybe probably put you into some trouble. And again, also, we've seen scenarios where the founders or the builders, they usually focus heavily when it comes to onboarding checks. And I know Senator covered the aspect of KYC, KYT more comprehensively. And when they're looking at the onboarding checks, they don't more or less put emphasis on what happens after. So you find maybe probably a user has been verified when they are being onboarded, And now when it comes to ongoing activity after being verified, most businesses, and especially for startups, they don't want to monitor what type of activities this particular user is engaging themselves into. So maybe probably by the time you are realizing later on, it's too late, and maybe probably you have too much exposure to illicit flows. So maybe the takeaway to sum this up is that if you look at the risks which comes with virtual assets, ideally they're usually rarely hidden. And mostly you'll find they tend to throw some early warning signs, but it's only that most businesses, especially the young players, they tend to ignore this, only to realize later that by the time they're reacting to something which has already become even more complex. So what maybe probably we normally try and encourage young startups and innovators is to try as much as I can to have these frameworks in place, which can also be able to help them monitor the kind of activities which these users are engaging with whenever they are conducting transactions within their platform. I think once they have the robust tools and systems and policies in place, will definitely make them to be more in control. And the longer they wait to implement all these, because maybe they look themselves as startups, then the more they might end up reacting when things get out of hand. So I think those are some of the warning signs which we've been seeing, maybe from the type of cases which we've been trying to handle in-house. Thank you so much.
Thank you, Sarah. Please remember, Sarah has said, make sure that you check shift in users' behavior or profile, and many others that he has talked about. Now, we have checked about the regulation, we have looked at the compliance aspect, and now I would like our speakers to give us like advice. Now, what are the direction? To you, Bill, as regulation becomes more structured across Africa, what is one thing you would advise startups to get right early if you want to avoid future regulatory challenges?
Thank you. Thank you for that question. I think that's an excellent question. So in my opinion, the one thing that I would advise startups to get right early is their compliance architecture. So we've gone through this whole webinar, and we see that the recurring theme is on compliance. And also just the whole reason we have this regulation is just to, there are a lot of compliance requirements, which of course startups, and Senator has submitted very wonderfully. I am going to look at that AMD forensics course that Senator took, because it was very well submitted on just what is expected and what is to be done. So now that the space is regulated, of course, startups can no longer treat compliance as something to add later, just as Senator wonderfully put it. So it has to be built into the company from the beginning. The product, the customer onboarding process, the transaction monitoring process, the custody model, the treasury flows, the governance structure, the market entry strategy. So all of this, you have to build in compliance. The first practical step is to stay updated on the compliance requirement in every jurisdiction where the business operates or the services are used. So a startup should know whether it needs a license, it needs registration, it needs sandbox approval, a waiver, or a direct regulatory engagement. So it should also understand which regulator is responsible for which part of the business, because as I'd said earlier, you might actually have more than one regulator. So the second step is to document everything early. So regulators will want to see your policies, your controls, your audit trails, your board oversight, your ML procedures, your risk assessment, cybersecurity measures, data protection procedures, customer due diligence. You see how many compliance requirements are there, suspicious transactions reporting, and how the business deals with high-risk transactions. So if you document all these from the onset, it is easier, because if a regulator asks, you already have everything and you just give them that package. The third step is to avoid waiting for a bank, a regulator, or an investor to force the issue. So by the time a regulator is asking a difficult question, or a bank that you're integrating with, or the regulator is sending an inquiry, it may already be too expensive to fix the business model. So if you go ahead of that, of course, you'll be in a better position. So in short, my advice is this: build compliance before you scale. So you scale while being compliant. So that does not mean that you're slowing down innovation. It means that you're building a company that can scale without breaking trust. So you already have trust with the regulator, you already have trust with your partners. And regulation is something that it's no longer coming. It is here with us. Back in 2022, you were saying regulation is coming. Now regulation is here. So the startups that will survive and grow are the ones that can innovate quickly, but also explain clearly to regulators, the banks they're integrating with, investors, and the users, how they manage risks. But I will close there. Thank you so much.
All right. Yeah, thank you. You've heard. Thank you. If you think compliance is expensive, try non-compliance, yeah?
I like that.
All right. So, Senator, for startups that are still growing and may not have large budgets, like for instance, let's look at Kenya, the draft that was out in March, and they're imposing a significant minimum capital threshold. Considering this screening tool, the monitoring tool, they're equally expensive. What is the most practical way to build compliance into the operations without slowing down innovation?
Thank you very much. If you ask me, that question is a gold mine question. And I hope that by the time I've answered it, there will be any gold to mine by guys over here. You see, innovation is exciting, and there are opportunities that come with innovation. And naturally, innovators focus on the strength and opportunities around the innovation. But regulators will always be concerned around the risk and threats that these opportunities throw up in the markets. And so for an innovator, it will benefit you greatly if, as Bill has emphasized finally here, that you build compliance into your innovation, whether it's a product or a service. At Infusion Lawyers, where we get to provide services to both the startups, the early stage startups, and in their various stages of growth, as well as the more established ones. Practically, I can recommend a few ways you can go about this. First of all, when you think about getting licensed, right, and you are only just a startup, still in your early stages, of course, you don't want to start thinking about meeting those requirements, or if you're at the Kenyan end or even at the Nigeria end, where we have about 2 billion for crypto exchange, for example, 2 billion naira anyway. What you should start thinking about is strategic partnerships. How can I strategically partner with already licensed entities so that I do not need to put my very limited resources into investing in licensing, whereas I don't even have enough user platform or user growth to back up whatever I've invested in licensing. So look at strategic partners. If you look around your own ecosystem, whether as a crypto wallet service provider, whether as a real world asset service provider, whether as perhaps an OTC, over-the-counter service provider, you should be keen on knowing the big boys in that sector and be able to just position yourself as one who can bring value to their markets. That way you could be able to leverage their own license while you're still building your own platform and of course your own user base. This we've done this with a lot of startups in Nigeria, along with our partners in other jurisdictions as well. We've always been able to guide startups on how to go about these things safely, rather than getting out of the market to start real estate business. So that's what I can say, and that will help you really focus on your UI, UX, your product innovation, so that you don't put too much money into capital reserves while you don't have your platform going. Another way to go about this is what you might call, I would say, adopting a modular pay as you grow strategy. How do I mean? So you will have KYT, KYC, and KYB tools that are built for enterprise. Those who built these things for enterprise already contemplate that you are relatively established as an enterprise. As a startup, you don't want to go spending so much money getting into an enterprise subscription. It's very expensive, or usually expensive. So rather than going with that, I would say you could use a modular API for KYC, KYT, and ensure that the one you're looking for or you're using is able to provide the option of what you call per check, rather than a flat rate or a flat fee. If you go for a flat fee, it means that irrespective of the volume of transactions, irrespective of the volume of user base that you have, you will end up paying exactly what the other big boys in the space are also paying. That's a lot of loss. So try to also get into the negotiation room with these service providers to make a case that you would rather want to be charged on a per check basis rather than a flat fee. That actually works. And I think this has worked for some startups who have been able to position themselves as bringing value to that ecosystem. Position yourself as you are fast growing, you look forward to building on your potentials, and you believe that you'll be able to bring more users to use it. At the end of the day, you might just be able to strike a good deal with these guys. Because of our time, I would round off by saying, do not think about compliance, licensing, all of these things from a point of view of negativity, in terms of they just want to kill our innovation, government don't like us, and all that stuff. What you can do and what you should be doing is to position early. I know 1, 2, 3 or more startups that positioned early, even long before the licensing and all that requirements came. What they did is this: they positioned in a manner that they adopted what I call, or what is called, self-regulation, right? I think that startups really downplay the importance of self-regulation. Self-regulation means that regardless of what the government or the regulators require or demand, you are also disciplined enough to come up with self-regulatory frameworks or mechanisms to check yourself. Now, many big businesses that checked themselves early when they were startups, they eventually were rewarded big. Why? Because rather than paying expensively for not taking steps early, they are now reaping the fruits. So you're not the one that the regulators will be striking down in 5 years' time. You'll be the one the regulators want to have in the room to co-build with them. So I don't know. I have very fine examples. For example, I didn't want to mention any platform at all, but I think just for the purpose of the guys on the platform, I could mention just up to 2. I know, for example, CNGN. CNGN is a local stable coin by a sister company, I believe, of A&D Forensics. At the time when Nigeria was zero on regulation, zero on anything protection, as far as virtual assets was concerned, CNGN was already positioning to ensure that whenever the regulators wake up, the regulators will not wake up to meet CNGN in a bad place. They will wake up to meet CNGN already doing those things that they would do if the regulations were already out there. And by virtue of that, CNGN is able to now competitively launch faster than others because it's been there trying to do the right things. The right things are not in any closed space. They are not secrets. If you just watch or ask questions, you will know what you need to do in terms of self-regulation. Self-regulation helps a lot. I also know one other company. I will not mention their name now. It's a global exchange. It started since 2011 when I was still about to, I think 2011, I just walked into the gates of the Nigerian law school in 2011. And they were already doing stuff, but they applied self-regulation. Down to 2026, I see this global exchange as one of the most compliant ever that you will find because the culture of self-regulation was there very early. So it was not hard for them to meet with the requirements of governments and regulators across the world, no matter jurisdictions they expanded to, because that culture was already there. I would challenge every builder in the house to please imbibe that culture of self-regulation early, so that by the time your governments and regulators are ready or fully ready, you would have already been very ready for them. And you can have conversations with them confidently to go co-build the ecosystem along with them as well. After then, you could then, have a chat with guys like Bill and myself about how you want us to use our associations as leverage to get to speak with the governments and regulators across these jurisdictions. Thank you very much.
All right. Thank you so much, Senator. You've heard, do not allow yourself to be slowed down. There are strategic partnership. There's something that Senator has talked about, pay as you grow. There's also the self-regulation, and he has mentioned a number of organizations that have adopted to that. Now to you, Seven. You only have 2 minutes, yeah? Based on what you've seen across investigation and advisory work, what separate businesses that successfully manage risk and compliance from those that struggle, and what is the one mindset shift startup need to make today?
Wow. Hello, Rhoda. Thank you so much. Thank you so much for the question. In fact, I was really enjoying when Senator was taking us through those key pointers, and I believe from whatever he's shared, he has aptly covered the question which I was supposed probably to also answer. So I wouldn't want to add or deduct or even comment to whatever Senator just mentioned, because if you are a startup and whatever our lovely speakers have mentioned, and you don't put them into consideration, I don't think if I go ahead and answer the question, we will do justice to whatever has already been laid as a foundation as this conversation basically goes. So probably from my end, I will just appreciate those key pointers in terms of guidance and next steps of action. And I believe for our startups, who joined this particular call, you really need to take whatever the speakers have mentioned into consideration, so that I wouldn't want to spoil whatever has already been built by trying to add much into the point, because I can also see the fact our time is also running out. So with that being said and done, allow me just to echo the same sentiments that Bill and Senator have mentioned around that the next steps which startups really need to put into consideration. And I think every startup which needs to remain stronger within the African business need to take into consideration the compliance aspect in place. I know we normally talk about customer is always right. We normally talk about the ongoing support we want to give to our customer service center, the ongoing support we want to give to the product development team. And I think that's also the angle which most startups really need to focus on thinking on how can we make compliance not only as a one-step action, but as an ongoing thing, even as they continue building and scaling their solutions. I think that's what I'll be able to add into that particular point, and allow me to throw the ball back to you. Thank you so much.
All right, thank you, Sewe. Now, there's a question that Dennis asked. UAE regulator VARA seems so solid. What can another jurisdiction copy from that regime? To our speakers. UAE regulator VARA seems so solid. What can other jurisdiction copy from that regime?
I will let Senator take this one.
All right,
Oh,
Senator.
Bill, I see what you're doing, huh? All right, I will take that. VARA, which is the Virtual Assets Regulatory Authority of the UAE, is a very, very innovative approach to regulation. And it's coming at a time when the whole world was actually waiting for the US to get it right. The whole world was waiting, hoping that perhaps the UK will make the move first. But it was the UAE, ever conscious around investment flow into their markets, came up with the idea of VARA. And centrally, the VARA, unlike the approach that most other jurisdictions have taken, which is what some people call the twin peak twin peak approach. That is, you still have your central bank or reserve bank, you still have your Securities and Exchange Commission, you still have your relevant FIU, financial intelligence units, or what have you, become the bodies coordinating themselves to regulate your sector. You have this kind of thing in Kenya, in Ghana and all, but UAE has taken another dimension. The UAE has decided that rather than having the existing regulators coordinates to regulate that sector, they should have a separate and independent entity specifically focused on virtual assets regulation. And that's why you have the Virtual Assets Regulatory Agency. It is an agency created by statutes. It is supposed to work independently, although also collaboratively with other regulators. What can Africa or other countries learn from this? Well, I would say what we can learn from VARA is that, one, we need African jurisdictions to work closely with the legislatures to ensure that we have separate virtual assets acts, right? I know that Kenya has it. I know that Ghana has it too. Mauritius also has it. But in Nigeria, there is no specific law on virtual assets. Go to South Africa as well. There's no specific law on virtual assets. And some other countries, right? So we need that to happen. Once that is happen, I think we'll have improved clarity, and then we'll be able to also avoid needless frictions. I'll paint a picture of what I mean by needless frictions. For example, in Nigeria, where we have not been fortunate to have a law on virtual assets regulation passed by the National Assembly of that country. The situation we have is that the Investments and Securities Act has defined virtual assets as securities. And there is no other law in the country that has defined it otherwise. Now, the problem with that is that you will put the Central Bank of Nigeria in a very bad situation, whereby because they don't have a regulatory authority over securities, they will find themselves handicapped. And you cannot afford to be an handicapped central bank if, for example, as Bill had said earlier, stable coins are being used to enable transactions such as remittances, cross-border payments, as well as local transactions. That, if you ask me, is a central bank business. So that's what I think we can learn from VARA. We need to be able to either, one or two ways, either establish separate entities or regulatory agencies for virtual assets, or if that is too much of a call, which I believe it is for many African countries, we should have clear virtual assets regulatory laws that should finally define the obligations of each coordinating unit or regulator, so you don't have frictions in the markets, so that you know who has authority over what. In Nigeria today, the Nigeria Revenue Service, NRS, has come up with a framework called VARA. There's no way in the world I have seen a tax authority come up with a virtual assets regulatory framework. Nigeria is establishing that record the first time. And I hope that we do it so well that Bill will be tempted to also sell it to the Kenyan government as well. Thank you.
Right, all right. Thank you so much, Senator. And now, please, can we give our speakers a round of applause for such an amazing discussion and the perspective that they're given to us. I don't know if there's any other person who has a question. We can give like a few minutes. If none, please, I will be sharing the feedback form. We'd like to hear from which area you would like us to improve next. And now over to you, Chioma.
Wow, like I've been so engaged with this interesting conversation so far. Well done, the A&E Forensics East Africa team for putting this out. Thank you to our amazing speakers, Senator Bill, Rhoda, for also moderating this section. So at this point, I would just want to, let's say, finalize or bring the webinar to a conclusion. In fact, I think this is the longest of webinar that A&E Forensics has ever hosted. It's always been 1 hour, but I think the conversations kept going smoothly, and that's a very good one. So apparently A&E Forensics has different branches, and we are present in Nigeria, East Africa, Kenya, Ghana, even what's it called? Even Senegal, yeah, the French-speaking guys, yeah. So what we do is a whole lot, but I will just niche it down to the topic for today, what we've discussed on. I appreciate Senator for all he's been doing so far. Senator is a proud alumnus of the Academy, and I'm also glad Bill is also going to be taking up that tag very soon. So apparently, we do trainings for law enforcement. Yeah, we do trainings for also compliance officers. We've heard a whole lot. In fact, yesterday, when I came online, because I've been away for some time, when I came online, I saw that the CBK is actually recruiting for some crypto compliance roles. And I was wondering, who are those people going to fill these roles, right? Because it's a whole lot, and it's very strategic. And this is the first time something like this is happening. And this is where, what's it called, development, building yourself with skills, having the right certifications, the right qualifications to fit into this role. I always tell people one thing. there is not as if compliance has not been in the picture. We've had compliance officers, even in the traditional finance. But way back, even when we started this training, it has been a way of probably you riding on the wings of what is trending and getting to the top immediately before the likes of Bill now that already understands what the traditional finance is. Imagine Bill coming to take this course. You can't even see his back again. You could see the way Senator is flying, right? So you have that opportunity now. I'm happy Kenya is opening up. So you have the opportunity now to take these certifications. The next cohort of our certified cryptocurrency compliance specialist training will be in June, right? So we've been trying to do some registration. So the registration link is actually open. So please register. It's actually selling at a discounted rate at the moment because we've gotten so many feedbacks. When you compare this to some of the trainings or courses you take from that are not Afrocentric, one good thing about this training is that it's Afrocentric. You could see the way we're discussing Africa. We understand the landscape. We understand the pain points of Africans. Come on, when you go to things like maybe CoinMarketCap, or even when you want to go and purchase tools, you see that the pricing is billed in dollars. How will a startup cope? Talk about the trainings. How will they cope? So this is why we are here. We're solving the pain points of Africans, and we understand that as well. So our training is Afrocentric, and it covers everything, every typology you need to see in Africa. It covers every landscape you need to see in Africa, and it takes you from a beginner level. So even if you've never used crypto before, in fact, you've not understand what crypto is, you've never even heard it for the first time. I always tell people that come across me that even before I came into this space, I never knew what AML was. So if you were like me at that point, no problem. The course is for you. So we take it from the beginner level. It has 5 modules, right? And it's done across 5 days. So you know what blockchain is, what cryptocurrency is all about, stable coins, and all those things you'll be hearing. You will learn about them. Then you will learn about the financial crimes that occur with cryptocurrency. A lot of you have been hearing about money laundering. It's beyond money laundering. We have terrorist financing, what's called ransomware, right? We have people butchering. A lot of financial crimes are happening with cryptocurrency. You will learn about all of them. And one interesting thing about our training is that you are not just learning about it, you're learning how to also use tools to fight or prevent. One good thing about compliance is that we play at the proactive stage, right? Investigations are reactive, right? As a crypto investigator, somebody must have lost funds before you come into play. But as a compliance officer, you're there to prevent that fund from even getting lost in the first place. Okay, so that's the beauty about compliance. And we've also so after that, you also go through the regulations, and I think this is where the legal experts, that's where they shine very well. I'm sure that was even Senator's best module during the training, because that's where you go through the regulatory landscape in different ecosystem. And then in module 4, you learn about crypto compliance in proper. Everything you need to know, how you need to onboard, how you need to screen the people, transaction monitoring, continuous monitoring, how you need to also file your reporting to probably the NFIU or the FCA or any financial intelligence unit of any country that you are in, right? So, and eventually you will learn how to use these tools. And we also saw that these tools are expensive, yes, when you look at them. And Senator gave a very practical and realistic approach to it. You don't need to go for the enterprises, and even we actually also saw that gap very early, and we also tried to solve that. So we'll show you the tools we have. We'll show you how these things can help you as a compliance officer to be a super crypto compliance officer. And in the end, you can sit in any position, because by the time you pass the exam, you become a certified crypto compliance specialist. And when CBK throws out a role in this position, you will not say, hey, I'm not qualified. No, you will be qualified, because as at that time, you understand it, you've practiced it as well. So we have even some alumni in this chat or in this webinar. I can see Mishak. Mishak happened to be the best graduating student for the last cohort, and I believe he's doing very well for himself, right? So it will be very interesting, and I'll be so happy to have you join our next cohort. In fact, I'm waiting for Bill's application today, all right, so that we can push this frontier. we can fight these bad actors with our intellects. Okay, I believe together we can. So I don't want to take much of our time. I want to thank you all for also being part of this webinar. Apart from other services, because I've really relied or stayed on the 3CS, we also do AML audits, right? A lot of, from what we do, we've seen a lot of fintechs, a lot of VAS. Maybe it is when they want to go for, maybe to partner with a bank, or they want to go for, maybe get raise or get investors. That is when they know that they have to do their independent AML audits. But that is the fourth pillar of a compliance program. Why haven't you done it since? All right. So we help you to do that. We also help in your cybersecurity posture. We do vulnerability assessment, penetration testing at affordable fintech price. We know that fintechs are actually building with compliance in mind, and that is where we help you out. Okay. So if you need any of our services, please feel free to reach out to us. So thank you so much for staying up till now. Thank you once again to our speakers, Bill, Senator, and thank you to Rhoda for moderating, and to Sewe, our managing partner for East Africa. Thank you so much. So I think I'll hand it over to you, Sewe.
All right, thank you so much. And that was explosive. And I believe for our participants who came here, maybe probably with lack of clarity in some key areas, I believe these conversations and discussions have maybe probably cleared some gray areas that you had. And that's why we have also posted the feedback form. You can maybe probably take a minute or two, fill it. And in case maybe you'll also want to participate in the upcoming courses, which my colleague Choma has mentioned, we have, of course, also dropped some of the links you can register as well. I don't want to keep you here. Thank you so much. Enjoy a good night, and see you at the top. Thank you so much.
And also feel free to follow us on our social media platforms for updates, and join the community because you get first-hand information. Thank you.
Thank you.